Hey guys, Eric here, Mr. Fired Up Wealth. Want to do a quick intro to this video just to explain what I'm covering today. Now, of course, there are a lot of new investors to the market right now, a lot of new retail investors, which is great. I'm a retail investor myself. I've been investing in the stock market over 20 years. This video today covers my top 15 investing rules. Now, these are rules that I've lived by over the past 20 years, and I've really learned them as I've gone along. And so I want to share them with you because I think they'll be helpful to you in your investing journey. Now, if you don't know anything about my background, just really quick, I recently resigned in November of last year from a corporate job where I was selling software services, and I'm now financially independent, retired, self-employed, basically doing this to help educate you and share knowledge and information. I spend my day researching stocks and managing my Discord community and doing videos on YouTube, which is great. I have a lot of fun doing it. So today we're going to cover top 15 investing rules. Now, this is a snippet from one of my masterclass videos. I have an entire masterclass series that you can get access to through Patreon. They're on Vimeo, and you can get access through the Elite Plus tier on Patreon. So if this is something that interests you, this type of content, check those out. Each of those videos are about an hour long. There's 5 right now. There's going to be 12 in the series. I'm working right now on the 6th video, which is going to be Introduction to Technical Analysis. Now, we use technicals here in Fired Up Wealth to get better entry and exit points, but we really are focused on long-term investing, occasionally a swing trade, but mostly focusing on long-term investing to grow wealth, sustainable, true sustainable generational wealth over time, over years of investing. So this video should be very helpful to you. And if it is, please do hit the like button, subscribe to the channel if you're not subscribed, click the little bell to get notifications, drop me a comment. But without further ado, let's get started. So let's get kicked off. I want to talk about my top 15 investing rules. And you might have seen this. I started my journey with this whole Fired Up Wealth project back in 2019. And Medium was the first place I started. I actually started as a writer, not as a video creator. And this is one of the first things I actually wrote were my top 15 investing rules. I also made a video on YouTube shortly after that. But rule number 1, I can't stress this enough, only invest money that you can afford to lose. There's so many people that are trying to, make a quick 10%, like, hey, I got this money for my house and I'm going to see if I can turn 100 grand into 120 grand in a month before I have to actually bring the money to closing. You're going to get yourself in trouble. If you need the money within the next even year or two, you have to be very, very disciplined, very careful how you're investing. You really should only invest money you can afford to lose. And for most people watching this video, you're probably focused on long-term investing. If you decide to be a trader, there's nothing wrong with trading. Just don't do it with all of your assets, in my opinion. You need to have a long-term investing account, and you can trade with a small percentage of your assets. But even, either way, whether it's investing long-term or if you're trading, you really shouldn't be messing around or investing or even trading unless it's money that you can afford to lose, or you'll get yourself into a lot of trouble. Rule number 2, do not buy all shares at once. We're going to talk more about this later with dollar cost averaging. There's a couple different ways to define dollar cost averaging, and I'll get to that towards the end of the video. I typically, if I'm buying an individual stock, I usually buy 20 to 25% at a time or per lot. So as an example, say I want $10,000 in a stock, I might buy $2,500 and buy 4 different times. Sometimes I dollar cost down and sometimes you actually dollar cost up, but you want to leave room so that it goes lower. Don't buy everything at one time or in one day. Try to do it in increments over a period of time. Rule number 3, no FOMO. That's fear of missing out. Don't chase stuff just because you're afraid you might miss out on it. If Bitcoin gets to 23,000, people are jumping in. What made Bitcoin different at 23,000 than when it was 15,000 a year ago? So you see that a lot. A lot of these stocks, especially this year, you're seeing a lot of people just chasing that FOMO. That's fear of missing out. Do your best not to FOMO. Try to be disciplined as an investor. Don't chase stuff. When we get later in this masterclass series, we're going to talk more about moving averages. If a stock is way above 100 and a 200-day moving average, it can stay that way for a long time, but I generally try to buy things when it comes back down to those moving averages, even if that means I have to actually pay up. I'm paying more later, because that's just how I like to buy. It's worked for me over the years, and it's just discipline. But just don't do fear of missing out. You see so many of these SPACs and these new hype companies where people will jump on the train too late, and all of a sudden the stock collapses 50%. Now you're stuck holding the stock. They call that a bag holder. You don't want to be a bag holder, so be careful with FOMO, fear of missing out. Rule number 4, please pay attention when I say this. Never be afraid to take profits. It doesn't mean liquidate your winners or anything like that. I'm simply saying that you can take a few chips off the table if something comes frothy, especially if it comes parabolic. If you have a stock that goes up 200% in a month, a lot of times that means it's parabolic and it can come back. So a lot of times what I'll do, if a stock runs really hard, say 300-400% in a short amount of time, I might take my initial investment. Say I put $5,000 on a stock, and in 3 months it's $25,000. I might sell $5,000 worth of that stock, keep the rest as what they call house money, and let it ride. It's just, you have to be disciplined though, and you have to take some profits. You can always buy more if the shares go down, but this is very important for outperformance. Rule number 5, diversify your portfolio to hedge risk. And we're going to talk about some sample portfolios. Every person's going to be a little bit different on how they want to diversify. You can do that with a lot of different ways. I mean, you can have Bitcoin, you can have gold, you can have real estate. There's lots of things you can do as an investor to diversify. But if you just think of stocks, you also need to diversify stocks. Don't just have all technology. Don't just have all growth. You need to have a balance in the portfolio. We'll get to more of that in a little bit. Rule number 6, you need to separate all emotion from investing. This includes dwelling on past decisions. You see so much, I wish I would have done this. I should have done that. I should have bought at this price. I should have sold at that price. At the end of the day, guys, this is about investing in stocks, which are a vehicle for you to generate wealth. That's it. No emotion, no shoulda, coulda, woulda. There's always another opportunity. If you had that much conviction about the stock, you should have bought it back then. If you're looking now and say, I should have done this or I should have done that, you probably didn't have enough conviction. Even if you did and you missed it, probably still going to go higher. So feel free to buy the stock and know that you might have to actually have some pain before it goes higher. It might go lower before it goes higher. But don't beat yourself up over dwelling on past decisions or saying, I wish I would have done that. I wish I would have done this. And I see it a lot within the different Fired Up Wealth groups. Once you can get beyond that and get rid of that emotion, it's going to make you not only a better investor, but you're going to sleep better at night as well. So please do your best to focus on rule number 6. Rule number 7, do your homework. I think most of the people in the Patreon do a good job of homework. A lot of us collaborate on stock ideas, but you see, especially in places like Facebook and YouTube and places like that, people just buy stocks because somebody else told them to buy a stock, or because they saw a video on it, or they saw a post on Reddit or Wall Street Bets or whatever. Do your homework. And it should be a lot more than what rule number 7 is saying. Rule number 7 is saying, if you can't explain to someone at least 3 good reasons to buy a stock, then don't buy it. You think of Peter Lynch, and we'll talk more about Peter Lynch in this series. He's, one of the people that I look up to. I would have loved to have Peter Lynch as my mentor, but there's a book called One Up on Wall Street. If you haven't read that, please read it. We're also going to do a video later in the series that's going to cover some of his methodologies. A part of how I operate is because of Peter Lynch, and he was a great investor back in the Fidelity Magellan Fund. But anyway, so if you can't explain at least 3 good reasons to buy a stock, don't buy it. And Peter Lynch used to actually, there was I can't remember exactly how the verbiage went, but essentially, having kids draw with crayon on a napkin why they should buy a stock. A lot of times it's just investing in what you know and things that make sense. You see other people using it, you like the product, but you have to have good reasons and do homework. And this series is going to show you how to do much deeper analysis than just, 3 good reasons to buy it. You also need to look at things like fundamentals, management, TAM, which is total addressable market, the overall macroeconomics. There's lots of things that you should look at as an investor. But at the end of the day, it really comes down to, investing what you know, but doing your homework and understanding the companies that you're investing in. Rule number 8, patience is critical to long-term investing success. This is very important. I can't stress it enough. with the recent market, you're seeing stocks go up, every day, and the expectations are a little bit out of whack, I think, especially if you're a new investor. Patience is going to be critical to long-term investing. If you're following the Discord channel for Fired Up Wealth, we had stocks even in the last few months where we were buying things like Cloudflare, and they've dipped down a little bit after buying them. People were panicking, and now the stock literally is, a couple 100% higher than it was before, 150% higher than it was before. Things like Ring Central is a good example too. You bought it, kind of dipped down, and now it's all-time highs. So patience is critical. You really should be investing as a long-term investor, thinking, what's this stock going to be worth in a year? And you're always evaluating your stocks. So you're constantly, each quarter, you're watching the earnings, you're watching the news, you're following the tickers that you own to make sure, things are going correctly, that there's no bad news, et cetera. Because if the story changes, sometimes you have to move on from a stock. But patience is critical to long-term investing success. If you are bullish about a story and you think that story is going to unfold, it might take time for that story to develop. And sometimes you have to wait a little bit to see your rewards. And as long as you do your homework on the company and have conviction and you have patience, a lot of times that patience will pay off and you'll get into those stocks earlier than the masses will, and you'll have better rewards and higher returns, and you'll outperform the market. If you lack patience, you really should just hire somebody to manage your money for you. Rule number 9. The stock market can't go up every single day. Expect corrections and embrace them, meaning always have some cash. I always teach to have some cash. You'll see in a few minutes, we'll talk about different portfolio examples. I like to have at least 5%, sometimes 10% cash, sometimes more, depending on your risk tolerance and things like that. But there's buying opportunities, especially in individual names. So obviously the indexes go down. There's going to be specific stocks that oftentimes get pulled down, that get beat up unjustifiably. And those are the stocks that you're trying to dig and find that diamond in the rough that, hey, this whole group sold off, but this stock actually had a really good, earnings. There's everything going right. Why did this stock sell off lockstep with all these other stocks? ETFs, index funds and things. A lot of times stocks will trade with their cohort, and sometimes the cohort gets punished, and certain stocks, individual names, might get punished with that cohort unjustifiably. And if you're an intelligent investor, you'll take advantage of those opportunities and you'll buy them. But expect corrections and embrace them. These really are buying opportunities. Look at March of 2020. A lot of people panicked. The people that were buying that massive dip, I don't even want to call it a dip. It was a major correction, 30% loss, bear market. The people that were buying that, they're very happy today because they made a lot of money. There are a lot of stocks that are up 1,000%, 2,000%. Embrace these opportunities. Rule number 10. So this is important. Always have some cash. It kind of ties into the last rule, rule number 9. Always have some cash, AKA dry powder is what they call it. I like to have 5 to 10% as a minimum. It's obviously up to you. It's an individual decision. If you're really young, maybe you don't have as much, but 5% is always a good idea, even if you're brand new, even if you're 20 years old, because just like I talked about, those major corrections, those can literally change the portfolio over a lifetime. If you can get in some of those prices that are generational buying opportunities, it can change your life in a big way. So for me, it's worth having that 5 or 10% cash. Yeah, I'm missing out when the whole market runs up, 5%. I'm missing out on that. But my goal is to outperform the market and still have that cash position. And I've been able to do that successfully for a long time. There's nothing worse than having no cash when your favorite stocks are on a fire sale. It's awful. If you haven't been there before and you see your favorite stock and that the stock's going to be higher in a year and you're like, man, I wish I could buy more of that. That feeling is terrible. You can avoid that feeling by always having some cash. Now, if you're still working, you should be able to generate income and keep that cash flow coming into your portfolio every month, every 2 weeks when you get paid, whatever. If not, you're going to have to be strategic on either shaving some profits as things get frothy, or you might have to do income strategies like we do cash covered calls and things like that in the Fired Up Wealth Patreon. So we're going to actually teach how to do cash covered calls and other income strategies for investing in this series as we go on. Rule number 11, and this is really important too. I can't stress it enough. Cut your losses. If a story changes and you lose confidence in the future outlook of a company, do not buy more. Cut your losses and move on. Repositioning that capital quickly will allow you to cover faster. And this has happened again. You look at 2020 again, that March, April sell-off. I was selling particular stocks that I own. I own, like, for example, Macy's. I had it really just for a dividend, for income, because I was needing that income, to retire early. And so I had some of these high yielding stocks in there, and Macy's was one of them. And, it was actually starting to recover and starting to do well. Well, a pandemic literally flipped that upside down. Now, I knew it wasn't going to recover quickly, and I was down maybe 40, 50% or something. I sold at a loss, and this is in a taxable brokerage, so I'm able to tax loss harvest. I sold that at a loss, was able to reposition that money into Fastly, and got a 600% return. So I literally got my money, back. I recouped my losses from Macy's selling at a loss. I still got the tax deduction, and I was able to generate a massive gain off this other stock. So sometimes you have to cut your losses. And this is why I stress having individual stocks in a taxable brokerage account. And I like personally in retirement accounts, if it's a 401k, if it's an IRA, what have you, I like to have ETFs, because ETFs, you don't have to worry. And that's why I like having ETFs. In an individual brokerage account, or a taxable brokerage, at least in the United States, you're able to actually tax loss harvest. And we'll talk more about that in a future video as well. Rule number 12, beware of hype. And this is everywhere right now. If your neighbor who casually invests tells you about a hot stock, you're likely too late. You will buy high and you'll sell low. This also goes for social media, most television shows, etc. You think of some of the stocks where you might have bought a stock and nobody knew about it and it ran up 300%. And then all of a sudden you see it on CNBC or your neighbors talking about it. What usually happens? Usually what happens is then the smart money are like, wow, this thing got parabolic. They sell, like we talked about earlier, selling some of those parabolic moves. And now you've got bag holders. And this is rinse and repeat. The average individual investor, they're generally scared of the market. They're afraid to invest because they think they're going to lose their money. They think Wall Street's going to take their money. And here's why, and here's part of the whole vicious cycle. It's kind of rinse and repeat. So I'm afraid to invest in stocks. I'm not going to do it. The market's moving sideways. Nobody's making money, or the market's going down. Yeah, I told you so. I'm glad I didn't invest in stocks. These guys are silly. Why are they doing that? Well, then all of a sudden we get to all-time highs. Everybody's buying stocks. Everybody's talking about stocks. You go to a party, everybody's talking about stocks. And the hype just keeps snowballing. The euphoria, keeps building. That greed index keeps going higher and higher. And now all of a sudden, people that weren't investing are like, hey, man, Sally next door, I mean, she makes less money than me, but she's been investing and she's really doing well. I need to start doing this too. And then, so of course, you don't know what to do. You don't have a plan. You just want to basically buy a stock and make money, and that's your plan. And I see this all the time. Well, what's your plan? Are you an investor or are you a trader? Well, I'm an investor. Okay. Well, what are you investing in? Well, I bought this stock and I sold it for a 10% gain, and then I bought this stock. I'm like, okay, so you're a trader. That's fine, but you're not an investor. You got to have that plan and you got to stick to it. But, so these individual investors, they decide to start investing. Well, they're going to go find a stock that has ran 500%, assuming that it's just going to keep going up forever. So they'll be like, yeah, I'm excited. This stock's up like 500%. There's all this hype around it. People are telling me they could double from here. I'm going to put all my money on this one stock. Well, then what happens? It sells off. And the people that were in it, the smart money that were in it, 200, 300, 400, 500% of it, guys like me that were buying a long time ago, now I'm selling it and the stock price is going to go down and you're going to be stuck holding the bag. Especially in a normal year. This has been a very unique year this year in 2020, but this is very important. If your neighbors and people that normally don't invest in stocks are telling you about a hot stock, be very careful, because a lot of times it's too late. All right, coming down the home stretch for the top 15 investing rules. Number 13, focus on moats. If a company is best of breed, especially with little or no competition, it's likely a winner. If you know who Warren Buffett is, he always talks about investing in moats. A moat is just, you think of specific companies like Disney, right? Disney really has a moat on specific things like theme parks. I mean, there's not a lot of people that can compete with them. They own the rights to all the Disney characters, to Star Wars, to Marvel. It's really a moat. And some companies have very strong moats, others really don't. And the ones that don't have strong moats, I tend to avoid. And so you'll see that a lot with certain industries, with certain products, et cetera. Eric, why don't you invest in that? It's because I don't feel like the moat is strong enough that competition can easily come in and disrupt the company. So barriers of entry are important a lot of times when you think of moats. You think of certain companies like a Palantir or a Telos that have government contracts. It's not necessarily a clear moat, but it does give them a moat in the sense there's only a handful of contracts or people on that contract, on that vendor list. So it really reduces the amount of competition. So focus on moats. If a company is best of breed, especially with little or no competition, it's likely going to be a winner, and the stock's likely going to be a winner as well. Rule number 14. Don't let anybody, including me, tell you the best strategy for you. Try to learn from others, like me, from the group, from other people. Make your own path, create your own journey. Each person, I say this over and over and over again, each person has different goals, timelines, and suitability. Every single investor, every single portfolio is going to be different. Don't let anybody tell you the best strategy for you, and that includes reminding myself, Eric, why don't you buy this stock? Why don't you buy that stock? At the end of the day, I have my own strategy that works for me, that has for a long time, and I'll buy the things that I'm comfortable with that make sense for my portfolio. Rule number 15, probably the most important. Have a plan and stick to it. All right, guys, those are my top 15 investing rules. I hope this helps you on your investing journey. Please do subscribe to the channel. Please hit the bell for notifications. Hit the like button, drop a comment, drop by Facebook. We've got a private group there. Drop by the Patreon community. Join us on Discord. I appreciate your time and attention. I hope you have a great rest of your day. Take care.